there you go, Nancy. I see. And then anyone else, Nika and Mohammed or Rob, you can do that as well. So today is week 6. This is our week 6 of. Good morning, Nancy. This is our week 6, and as we were saying, what we were going to do last week was to sort of begin to do an overview on accounting and other issues like that. Today is going to be a deeper dive. It's going to be our first discussion around insurance, and that is not a reflection of how important it is. Actually, it's very important to have this conversation. I've had the opportunity to talk to Don Grau about each one of your companies. There is a particular sort of approach that you each will have. This conversation today is really not that. Don's going to give us an overview. And then what you can do is to, get his slide or outline or whatever. But Don, as the owner of Goldsboro Insurance, is available to you to discuss the unique needs of your company. So just for one other comment, so we have Denny Austin and Justin Acker from SG&H accounting firm that will be picking up in about 30 minutes. This might go a few minutes over just because we're giving each one 30 minutes. And in that conversation, we're going to go as sort of the next level down in accounting and some of the considerations that you're going to need to have and to take into consideration, I should say, in the very near future as well. So with that just having been said, one last thing, folks, is that after Danny and Justin's presentation, we're going to log off of this Hop-On platform and onto a Zoom meeting with Max Menke from Growth X Ventures, who's a venture capitalist out of San Francisco. Him and his partner are sort of coming into the Baltimore market, have a really unique approach, and have a great conversation coming up that's going to be on product market fit. We're going to do 2 sessions on this, and the first one will be starting today. So having said all of that, Don, thank you again for the time you've given. The floor is yours, my friend.
Thank you, John. Good morning, all. So we're going to have a discussion about the insurance aspects of your various businesses, and John was 100% correct. Everything that we talk about will apply at some level for you. So if I say something that doesn't sound like it fits your business directly, or there might be a more specific question for your particular business, we can definitely drill down to that at any time. And John's absolutely right. Pick up the phone, drop an email, drop a text, and we can have those conversations. What I'm trying to get across to you today is the concepts that you need to keep in mind as you develop your business, and to make sure that as you go through the life cycle of your business, whatever that may be, that you're keeping track of the risk management aspects of it. Fair enough? Okay. So I also broke this down into about a 20-minute drink out of a fire hose discussion. So I'm going to leave time at the end for questions. What I'd like to do, though, is let's start with the idea of interrupt with a question. And if I'm going to talk about it later, I'll say I'm going to hit that. And if it's too specific to you, then I'm going to say, let's take that offline. And if there's too many questions, I might just say, hey, time out, let me finish up, and then we'll leave some time open for it. But again, the bottom line is you've always got me available if you need me to go into some of these discussions. Make sense? Okay. Indeed. Let me share some screen with you. And everybody see need to know crucial concepts?
Yes.
Okay, give me a verbal because I can't see at this point.
Yes.
All right. Thank you. Okay, so these are exactly what it says it is. It's the basic concepts that you need to know for ensuring your technology-based business / startup, and we are all essentially startups, and we are all essentially technology-based, right? That's what the entrepreneurship piece of it is. So for the most part, 99.9% of this is going to apply to you. So why should you care what I have to say? Well, you guys, you startup folks, you bootstrappers, you entrepreneurs, you max out your credit cards until you can find an angel investors. You're my kind of people. I just love watching what you do. And because I own this business, I have the opportunity to play with the people I want to play with. If you're old enough to remember the series, It's Good to Be the King. Okay.
Mm.
So I like playing with these folks, and subsequently I've taken the time to go through and figure out what some of these new policies are, the cyber coverage, the technology E&O coverage, and some of those issues. And so they hit home for me, they make sense to me, and there's not a whole lot of folks out there that deal in the small businesses. So golly, this is very touchy. Okay. So when you go out and buy insurance, wow. Sorry about that. Okay, so nobody got up this morning. Holy cow.
What, are you getting some feedback?
No, I'm getting the screen flipping on me. Okay, so nobody got up this morning and said, I cannot wait to go out and buy some insurance coverage. That's exactly what I want to do, right? Nobody said ever. But if you have to go out and buy insurance coverage, whether it's for you as an individual, for your family, your car, your home, or whether it's you for your business, there's essentially 3 ways to buy insurance. And the first one is, there's 3 reasons you go out and buy insurance. The first reason is you're told to. So a banker for your mortgage at your house, the landlord if you rent an apartment or you lease an office. A client says, here's what you have to have. A vendor says, here's what you have to have. A board member wants you to have coverage, or the government comes in and says, you need to have this. The other reason is your own risk assessment. You wake up in the middle of the night and you said, my goodness, I've got a lot to lose here. I need to protect this. I don't want to lose it all. And then the final piece, and this is the one that I want to make sure that that hits home for you, is looking ahead. There's an exit strategy to your business. Maybe it's somebody comes along and offers you an obnoxious amount of money. Good for you. You want to be prepared for that. Now, wow, this is crazy. Okay. Very, very touchy. Let's see if this works better. Okay, this might work better. So when you go out to buy insurance, who can you buy from? You can essentially buy from 3 different areas. You can buy direct. And when you buy direct, you pick up the phone and you call Geico, USAA, somebody like that. And you deal with that representative at that company. The second way you buy is from a captive. So a captive would be somebody like a State Farm, Allstate, Nationwide used to be a captive. Farmers, that's a captive market. So when you talk to a captive agent, that captive agent essentially writes exclusively for that insurance market. Then there's independent agents. Independent agents are agents like me at Goldsboro Insurance Services. We have direct agency contracts with Hartford, Travelers, Selective, a bunch of different companies. And then we have brokerage arrangements with another 113 different companies. So we essentially take that information and put it to the right insurance company and make it work for you. So those are the 3 ways that you're buying insurance coverage. So we're going to talk about insurance coverage, and there's one distinction you need to know about the policies, regardless of what type of policy they are, which is going to be very important to you as you exit from the business, as your business continues to grow, and as you purchase more insurance coverage. And there's 2 types of policies we're going to discuss. One is what we call a claims-made form. I'm getting a little technical on you here, bear with me. And the other is an occurrence policy form. So here's the difference. When we talk about an occurrence policy, and by the way, these are typically liability, meaning you've got responsibility towards somebody else. When we talk about an occurrence policy, that policy typically is going to cover when the occurrence took place. And you're going to hear me give an example of a slip and a fall. So if somebody slips and falls and they file a claim, whether they file that claim when they fell or a year later, the policy that responds is the policy that was in place when the occurrence took place. Make sense?
Yep.
Yes.
The other policy is much, much more complicated. It's called a claims-made policy. And some of you may have this issue when we talk about different coverages. And some of you may have this issue when we talk about your line of work. So let me give you the example. I think I shared this one with John of a claims-made policy. Let's talk about a surgeon, and he or she graduates from medical school, goes into their private practice, and they perform 1 surgery a week, and in each surgery, they leave a sponge in the body cavity and sew them back up. Don't know why he did it. That's what he did. Now, 3 years later, those sponges start clogging and killing people. When's the claim? When he left the sponge in or when they died? Well, the answer is we don't know, we don't care, somebody's going to pay, right? So that's a claims made policy, meaning that something you did today may not raise its ugly head until down the road. So what you're going to see about claims made policies is that they go back in time. And the important thing to remember about going back in time is you can't today buy history.
Mhm.
So you need to plan your insurance policies, especially policies that are claims made for your exit. So let me give you a quick reason why this is important to you, and I think I shared this with John also. So if there's a policy that's a claims made policy, remember we're going back in time because something could have happened in the past that's going to rear its ugly head today. I get a call from one of my longtime technology clients. He calls me on Friday afternoon about 3 o'clock. He says, Don, somebody came along, offered me an obnoxious amount of money. We are settling on Monday. I said, Frank, that was his name actually. I said, Frank, that's great. What about the tail policy? What about this claims made policy that's got to continue on? Who's paying for that? And I got that puppy dog look like, what are you talking about? He hadn't called me ahead of time. We hadn't talked about this. The attorney for the other side didn't bring it up. His attorney didn't bring it up. Of his significant amount of money, he had to shell out an extra $85,000. I don't care how much he made. That's real money in my book. $85,000 because he didn't plan ahead. So a lot of this goes into planning. You cannot pick up insurance coverage, insurance protection today and not watch it as your business grows, as your business evolves. You need to plan for that future. And a lot of these policies need to be in place long before that exit strategy hits. So now let's talk about a couple of these common policies that most of you, in fact, I would say all of you are going to at least have to look at, if not absolutely pick up. And you're going to hear me break them into either an occurrence policy or a claims made policy. So here's the claims made policy. First one is an errors and omissions and professional liability. Let's include malpractice in there. There's some distinction between these policies, but for our purposes today, it's all the same thing. And here's what that policy says. That policy essentially says you are a professional, and what you do has a higher degree of care. And if you fail to do something, or you do it incorrectly, I should be able to come back after you and collect the monetary damage. That's essentially what it says. Does it make sense to you that that policy would be a claims made policy? It does, doesn't it? Think of a software developer. A software developer, and many of you in your businesses are hiring or gigging out that development work, aren't you? Right. So that development person, whether it's you or somebody you hire out, they put in a line of code today that doesn't create an issue until 2 years down the road when you install it at IBM. We want coverage, don't we? Right. So that errors and omissions policy is going to start out by saying we have coverage as of the day we write the policy, and it goes forward in time. And that's called a retro date. Every claims made policy will have a retro date. And let's say that we wrote for you, Angel, let's say we wrote a policy today for errors and omissions, and it would have a 10/20/2020 retroactive date and effective date. 5 years down the road, either I'm renewing that policy or somebody else is writing you a replacement policy. What should that retro date read?
5 years ago.
Exactly. It should read today, shouldn't it?
10/20.
Exactly right. Bingo. That's exactly right. It should read that date. It will only say one of two things, either the first day you wrote the coverage or full prior acts. Kind of makes sense, doesn't it?
Right.
We're going to cover everything. Or full prior acts or the date you first wrote the coverage. So in effect, if somebody comes along, let's just say, stay with you, Angel. Let's just say I write your coverage today, and 3 years down the road, somebody comes along and says to you, Angel, I got a price that's half of Don's, but their retroactive date doesn't come back to today. What's that tell you?
Right.
You're missing, that's right, you're missing a block of coverage there. No wonder it's less expensive, right?
Yeah.
So retroactive dates are absolutely important on professional liability policies, errors and omissions policies. And errors and omissions essentially is that coverage for what you do in your business, your profession. And I know I'm talking at 150 words a minute with gusts up to 210, but stop me if I pass over something too fast. Here's just a quick example of an errors and omissions policy claim. Okay, moving on. I'll make this deck available to you if you need it. Cyber liability. I'm probably preaching to the choir here. What are we doing now? We're all on computers. Every day we're on computers. You have data that belongs to people. You have intellectual property, both their personal information, potentially proprietary corporate information. Potentially you allow somebody to get into your system, get into their system by hacking through your system. You pass on a virus, blah, 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 blah. Cyber liability. Now, cyber liability has both first-party coverage, meaning it responds to you. If you're my client, you call me and say, Don, somebody loaded something to my system and my computers are now bricks. It's actually called bricking. That's first-party coverage because your computers are broken. Where somebody locks down your system and gives you a ransomware attack, that's first-party coverage because it's your stuff. Third-party coverage is when you're liable to somebody else. So you might be thinking, well, where's this occurrence and claims made come into play? Well, on the first-party coverage, that's all occurrence. Kind of makes sense, right? On the third-party coverage, where you're responsible to somebody else, some of that is also claims made forms. So that retro date becomes important. And continuous coverage becomes important. Here's a quick claim example for cyber liability. Employment practices liability, also a claims made form. And this is, the best way to describe this is, simplest way, is malpractice for your HR department. And right now your HR department's you, right? So what it is it's failure to hire, failure to promote, too fat, too thin, too bald, too hairy, too white, too black, too yellow, too green, fill in the blank. Everybody is protected today. And if you fire me, you didn't fire me because I couldn't do my job. You fired me because I wear button-down white shirts, and that's discriminating against me, or whatever the cause might be. The point is, even if it's something obnoxious, you've got to show up and defend it. And if indeed I'm 58 years old, which would easily be age discrimination. Do you know what the age is for age discrimination, by the way?
Any age.
40. 40 years old. So this is the type of thing that employment practices liability will pick up. This could very well be important to you because on the exit of your business, you potentially will have employees that may or may not like your exit strategy. And all of a sudden that joke everybody was talking about around the water cooler is offensive. Something to keep in mind. Here's a claim example. Directors and officers liability. If you've talked to advisors, they have talked to you about this. So directors and officers liability, also a claims made form, specifically says to you, the simplest way to put this is that it is malpractice for running the organization. So who cares how you run the organization? Well, people you owe money to care. Partners care. Right? So you and I are 50-50 partners now. Patrick, let's say you and I are 50-50 partners, and you buy me out at, make up a number, $50 a share. 3 months down the road, somebody comes along and buys you out at $75 a share. You think I'm going to show up on your doorstep? You think you're going to have to defend how you sold it to me for a whole lot less than you ended up selling the company for? You think who's going to pay for that lawyer to defend that if you don't have D&O? Can you say Patrick? Okay.
I think he's
there. You go. And most of your investors. That's my 20 minutes, John. So keep me honest here. Okay.
No, go for it, man. Go ahead.
So,
You're good. Go ahead.
So most of your investors and or advisors, if they're worth their salt, they're going to ask you if you have a D&O policy in place. So even though you may not pick it up initially, you're probably going to need D&O at some point. Here's a quick example of that.
Mm-hmm.
Okay, so we talked about what type of policies before? Claims made. Claims made have tails on them. And the thing we need to know about tails is that they have a retro date that goes back in time. And the only way we can buy that retro date is if we keep a policy running. And then that policy is going to stop at some point, and we may need to buy that tail on our exit strategy. Those are the important things to remember about claims made policies. So now let's talk about the easy ones, the occurrence policies. And we only have two of these to talk about. General liability. I call this public liability, but when you look at contracts from your vendors or your clients, even your landlord, they are all, sir.
Hey, Don. I'm not sure if it shows on your end, but I'm still seeing the directors and officers.
Okay.
We're one behind you. One more. Yeah, that's a claims example. Go ahead and go to the.
Are we a general liability? Are we a general liability now? Thank you. So everybody is going to require general liability. It's public liability. Where your errors and omissions was specifically talking about what you do, general liability, for the most part, doesn't care what you do. It's just the fact that you're out there with the knuckleheads that are going to sue you for everything. So if you took your general liability policy, Nancy, let's say it was yours, and you stacked it up against my general liability policy for my office, it's going to look very similar. It's going to cover for bodily injury to a third party, slip and fall, we typically call it. It's going to cover for property damage, my responsibility for damaging somebody's property. I go into John's office and he's got a brand new 65-inch flat screen that he's proud of, and I think it's crooked, so I go straighten it and it falls and breaks. That's his property. I damaged it. My problem. Reputational harm. I'm talking to Rob, and I'm saying something about John that's not true, and he sues me for reputational harm. Advertising injury is pretty self-explanatory. So everybody's going to require general liability. And we're going to talk about, if we have time, we'll talk about limits and contracts on that too. Here's a quick claim example. You seeing that? Okay.
Yes.
So as you can see from the claim example, general liability is just that. Everybody's got it. A photographer's got it. An insurance agent's got it. A startup doing pretty much anything has got that exposure. Okay. The last piece of coverage, which you're probably going to need at some point, is workers' compensation coverage. And workers' compensation is actually two pieces of coverage. One is the statutory, what's required by the state, and it's the actual workers' comp. And what it says is that if you have a W-2 employee or somebody who can be perceived to be an employee, and they are injured on the job in a work-related incident, then all of their medical bills are paid. There's some disability coverage. There's even some life insurance. But that's the responsibility of the employer to have this coverage in place. We get into tricky scenarios because some of you are sole proprietorships or LLCs, and you are the only member of that LLC, and everybody else you hire is a 1099 or a gig employee. So by law, you won't have to have workers' compensation on yourself. The state of Maryland and most states allow you to not carry it on yourself. But a lot of businesses you contract with are going to require that you carry it anyway. Can anybody think of a reason?
Because you never know when you'll take somebody on.
That's a great reason. Absolutely. Was that you, Angel? Oh, hey, Nancy.
That was Nancy.
So that's an
Nancy.
excellent reason that they would do that. And then the other reason is because if somebody is hurt badly enough, they're going to make a case that they weren't a 1099, they were an employee, so that they can get the coverage, right? So your potential vendor client doesn't want to mess with that issue. He or she knows that if they require you to have the policy, whether you need it or not, they're protected. So most of the time, you're going to need a workers' compensation policy. Obviously, you're all sort of tallying this up, and you're saying, what's this thing going to cost? So, let me back up. So the cost obviously varies. Obviously, it's going to vary based on how many policies you purchase. What's the exposure that you have? Are you making something that is ingested like a medicine, or are you making something that sits on a desk? What are the exposures? So that's going to vary. But one thing that you want to make sure that you keep in mind is, like your grandma always used to tell you, if it sounds too good to be true, it is. And we have a lot of people out there that are selling technology-based companies, and they're putting it in their square box and sending it out to you and saying, here you go, this is what works. And 9 times out of 10, it needs more work. Very, very few times have I ever talked to a technology-based client where we can put them in a quick square hole and say, okay, we're done, you're covered. Most of the time, there's some legwork needed there. And unfortunately, on some of these 1-800 get insured, you're not talking to somebody who's got that kind of experience. That's what you need to keep in mind.
Okay, so I think we can fairly do probably another 2 to 3 minutes, since we took about 5 minutes to get started, Don. So if you want to cover another topic or answer some questions,
so everybody's seeing if we have time screen. Okay. Do any of those particular issues jump out at you more than questions you might have?
Contracts, issues, and insurance. I had some. This is Angel. I have a specific question. So I don't know if I wanted to hear more about the reputational harm in terms of general liability, and I don't know. Are there parameters or like restrictions or boundaries around that in terms of like what's included, what's covered, et cetera?
Yes, there are. And we could read the policy together and you'd be looking for a gun to shoot me. So let's think of it this way. Every policy out there is going to have conditions, limitations, and exclusions, right? It's all going to be that way. So describing exactly what's covered is going to be very difficult. And most of the time when we talk about it, we talk about a scenario and say, okay, well, this would probably be covered because, or it wouldn't be covered because. It is not a full, most of the time, the personal and advertising injury that shows up on that general liability policy is not a full-blown media policy. So there is some coverage on there for that incidental advertising or libel and slander liability, but it is not a full policy for media liability when you throw up a website that defames somebody. Okay, and
remember yesterday we were talking about, or when we spoke, we were talking about Angel's company and the possibility of needing protection because if she comes up and that score somehow is viewed by the company that received the score as a reputational harm, then, not number one, would the insurance policy cover that? Number two, would the insurance company pay for the lawyer to cover that? Okay. What are the involvements there? And frankly, this is going to have, unfortunately, be the last question, just because we've got to get Justin and Danny, get them started. But if you could just follow up on that, and then everybody else with your specific questions, you've got the contact information
So
to share the thing.
Send me an
We'll
email
be
if
able
you
to
want
follow
the
up
deck,
those
and I'm
specific
happy to send it
questions.
to you,
Go
John,
ahead.
and Selena have that. So the short answer, Angel, is maybe it might even be professional liability. But even if the general liability policy doesn't pick it up, we could look at a media liability policy and see how much broader that may be.
Okay. Yeah, I'll probably want to talk some more and dig deep, because I'm trying to figure out, is this something where like I just had to have like a lawyer on retainer, which could be expensive, or like it's interesting the idea that insurance could provide protections, especially if it could support the legal expenses related to that. So I can talk to you more about
Perfect.
Why.
Back to you, John.
Great.
Thank you so much for your time, Don. Really appreciate you being involved with us. And like I said, each one we have in the cohort are going to have questions that need to be answered, really specific ones. Mohammed has, each one has unique questions, Patrick and the municipal governments and things of that nature. So anyways, we'll have that follow-up. Thank you for your time today.
Thank you.
So, folks, I need to now, Justin and Danny, if you would, there you go. I see, there you are. Thank you. I'm bringing you on now.
Hi, how are you?
Hey, Justin. Oh, good. Excellent, man. Thank you. And Danny. All right. So, folks, as I was saying at the beginning, we're going to take a deeper dive into the accounting side. This is that. And I'm going to, you can look at the bios, as it's already on the website and everything. So instead of spending your time on that, we'll just jump right in.
Okay. Thanks, John.
And Danny and Justin, you can kick it off.
So my name is Justin Acker. I'm a senior manager here at SE&H. And what we plan to do today is really do, as John was mentioning, take a deeper dive into the accounting function for a government contractor. We want to kind of assist you in kind of putting yourself in position to kind of build a kind of a growing company. So.
Yep, and then just a little bit of background on me. My name is Daniel Austin. I'm a manager in the same practice as Justin in the Tyson's office. I did want to start by saying this is a really cool opportunity for everybody on the call. We have a lot of companies that we know that get started and run into some of these issues too late. So you have your insurance question, you can figure out how to do that. We can help you with some of the accounting standpoint. It's just really exciting. One thing I did want to note, Don said that nobody wakes up in the morning and is excited to buy insurance. I don't think anybody wakes up in the mornings and is excited to do accounting either. But what we're hoping is that we can set you guys up so that, in a year and 2 years down the road, you're in a position to where accounting and insurance aren't an issue, to where, you can focus on the future like the CEOs and CFOs are supposed to do. So just to go through a quick agenda of what we're going to cover today. We'll talk briefly about who we are, what we do, and who we serve. Then we'll get into some industry terms and acronyms so you know what to look out for. We'll talk about a brief accounting overview. I know you already have a background on some of the basics of accounting, but this will be geared more towards the government contracting industry. Then we'll talk about contracts types, how to get started and what to consider. And then we'll touch on a pretty popular topic in government contracting, which is indirect rates. And then we'll briefly touch on allowable and unallowable costs and why they're important.
So just to give you all a little bit of background on the firm. So SE&H is a full service public accounting firm. We offer your typical service with your audit, compilation or reviewed financial statements, as well as tax work. We do personal individual tax as well as company, corporate tax. We also have a consulting arm within our firm where we do many different things in the consulting industry. Pretty much your typical kind of full service public accounting firm. We're actually headquartered in Sparks, Maryland, which is kind of north of Baltimore. We have 3 different offices within the DC Baltimore metropolitan area. We have an office location in Tyson's Corner, Virginia, Ellicott City, Maryland, and then our headquarters up in Sparks, Maryland. As you can see here, we have a little under 300 employees, and we provide all types of services there.
Justin, one thing I do want to add there is that one of the things that we pride ourselves on is that we can help companies at any stage from inception all the way through to maturity. We've seen several companies go from starting their business to selling. And what we pride ourselves on is that we can provide different services throughout your lifeline to continue to provide value over time.
Okay. So we'll kind of jump right in, really specifically for government contractors and certain things that you may potentially see within the industry. So we wanted to cover a few kind of industry terms and acronyms just to kind of get you familiar with a few things, and if there's some things that you may see, you can kind of put some kind of correlation there. So some of the industry terms and acronyms you'll see, we have KO or CO, which is referred to as a contracting officer. So really that's the agent that binds the government to the type of contract that's happening. So that's the decision maker. They're the one that are going to bind the government for making that decision. The next one here, DCAA, which is the Defense Contracting Audit Agency, and what that is actually came up with the DoD, and it's kind of the overseer from a compliance standpoint. They want to make sure that you're conducting these contracts in some sort of compliant fashion. So they kind of expanded to kind of all contractors. So they're kind of the overseers of all contractors there. Then you have the SBA, which stands for Small Business Administration, and with this one, this is a good one, and definitely can be helpful, for folks your size, just because it's a group that it has certain set asides, for you to help business, right? It's for you to help drum up and drive business with the hopes of you being able to, they want to set you up for success in the beginning, and then have you hopefully leverage from that to then be able to go out and win contracts on your own and try to do other things to kind of be set up for success. The next one here, SCA, which is the Service Contracting Act. What this does is this is a act basically that set a minimum wage for certain employees that work on a contract. So not everyone has the ability to earn kind of a lucrative wage depending on where you live at. So this SCA, which is the Service Contracting, sets a minimum wage that companies will have to pay employees, just so they can make sure that they're being provided an equitable wage there. Some of these next terms, GSA, which is the General Service Administration. So what they do is they manage contracts for standard business services, basically contracted by the government. You'll see more and more of this as you kind of go throughout your life cycle in the government contracting industry. But we did want to kind of touch on it kind of in the beginning. The next three with burden, funding, and indirect rates. We will touch on those a little bit later, but I did want to give you all just kind of a high level overview of what those are. So when you think of government contracting, you do have the ability to not only be able to charge your time that you're spending on this, but depending on the contract, you can also apply a portion of the indirect rates or the indirect costs that go into what you're spending on your employees or facility or anything, so that way you can be reimbursed by the government for those. So burden basically is just the application of the indirect rates to the direct cost. So you have your fringe, overhead, and G&A. You can apply that to your direct costs. Funding, which is generally it's the maximum amount of funds that the government has committed for a specific contract. So they could say, we're going to offer you this contract, but this is the maximum amount that we're going to give you on this. So you want to have an eye open for that. Indirect rates, which I mentioned when I was referring to burden, but basically those are the rates used when you're calculating to reimburse for the incurred indirect costs that you have on some of your contracts. The next two, FAR and CAS, these are kind of oversight kind of committees where you think about it. So you have the Federal Act. FAR stands for Federal Acquisition Regulation, and CAS stands for Cost Accounting Standards. And you want to be aware of those because those are the standards that you're going to have to abide by. FAR is for all government contracts. So if you have a government contract, you have to be in accordance with the FAR. And then for CAS, that's for certain contracts that are over a certain threshold. So I believe it's about 50 million. So once you have a contract over a certain dollar amount, then you have to be in compliance with those. So you want to keep an eye out for both FAR and CAS. And again, if you all have any specific questions on some of these industry terms, feel free to reach out to Danny or myself, and we'll be more than happy to share any information with you.
Yeah, and the big thing with these terms is that it's kind of a really boiled down definition for a lot of things that could expand from each topic. So we're just trying to make you guys aware of, when you see these words, there is more to consider that comes with it. So that's something that we're happy to answer. Government contracting, whether it's for federal or state, there are so many different things that can come from winning one contract that you need to be aware of. So hopefully these can give you kind of a base guideline that you can then, if you see these terms, there's more information there. You can either do research or reach out to us and we can help. So I'll get into a brief accounting overview as discussed. So, we know that you guys have had a background on accounting. So you know that the purpose of the accounting system and structure is to basically track financial activity. It's important to know where your business is at, where it's going, and how it's performing with accurate numbers so that you can make educated financial decisions based on it. So to the right, you'll see basically we call these account groupings in the audit world. So what these are is basically the general areas where you'll be recording assets and liabilities. The assets, liabilities, and equity are going to look pretty much like any other company. You're going to have just your general, basically where your company is at on a given date. The income statement is where it can be a little bit different. So that's where you get your revenues, cost of goods sold, and other indirect expenses, kind of what Justin was touching on a bit earlier. But basically, in government contracting, because of the way indirect rates work, which we'll get into more detail later, it's important to have costs segregated between the direct and then also the indirects of fringe, G&A, overhead, and then also unallowable, because some of the costs that you incurred that could be reimbursed by the government via the indirect rates may be expressly unallowable, which means that they're not going to reimburse you for certain costs, which we'll also give you a little bit more detail on later. But basically having an outline like this of groups that will then have a under each one will set your structure needed for long-term growth.
Okay.
And then in terms of when you're looking at an accounting system, some of you may already be on an accounting system. Some of you may be looking at them. Some of you may be keeping notes on a piece of paper at this point in time for where everything is at in your expenditures. So important things of what to consider is time entry. So government contracting, providing services and goods to the federal government or state and local governments. Time entry is a huge part of it because it's so service-based. So having a system that can basically segregate between direct, indirect, fringe, PTO, holiday, and then also between contracts for direct labor is going to be one of the most important things to set a structure for your company to be able to bill adequately throughout the contract. The other thing is reporting. As a CEO or CFO, your team is going to be putting in information, and then the system is going to be able to spit out reports that you can look at and analyze. You're going to want to know that the system has reporting that makes sense to you, that you can use key performance indicators. You can see what your numbers are doing and what they look like so you can make informed business decisions. Next is a contract module. If you only have one or two contracts starting out, it's not super important, but the more contracts that you win, the more complex everything gets. So having a contract module that allows you to track the revenue per contract, the costs, the direct and indirects applied is going to be a huge way to make sure that you're able to start, administer, and close out the contract adequately so that there's not a lot of time on the back end. For some of the more simple systems, there are add-ons that allow you to do some of this stuff in a way that is as complex as some of the more involved accounting systems. So maybe that's an option for somebody that says, we're looking at starting something basic. With these add-ons, we should be able to do some of the more complex stuff. Then you're looking at cost. I mean, these all have different costs, so it's important to understand what the cost and benefit is for your company in the short and long term. And then the general ledger, the general just usability of the software. It's important to have a team in place that can use what you're on and knows it very well. Because if you don't, you can get so far off track so quickly that it's then costly to come back and fix. So the usability of the system is very important as well. To the right, we listed some popular choices: Uninet, Deltek, Procash, Jamis, and QuickBooks. They're all varying cost and complexity. Unit's very well known for its time and materials software, and they're working on their contract module. Deltek is looked at as one of the biggest names in the industry because of their complexity of the contract module and how that works. Procash and Jamis are pretty good alternatives to those, and then QuickBooks is typically your base layer option that has some add-ons there. So depending on what your company's goals are for now and the future, it's important to get an accounting system and structure in place that sets you up so that you don't have to consistently make changes and look back on the past. We want you guys to be set up with a system and structure that allows you to be where you need to now without a huge investment, but then also built for the future so that there's not constant looking back at the past or fixing things that may be wrong. We want you to be able to, spend your time thinking about the future.
Is it okay?
And then have a team that can work on the accounting function.
So Danny, can I ask a
Sure,
question right there? Thanks. Yeah, it is okay to ask questions.
Well, it's just a quick question.
I'll defer to yours, Angel.
If you start out with like QuickBooks, for example, and you wanted to switch to a different product, is that a challenging thing to do, or is it pretty easy that they're all kind of set up the same way? Or do you kind of like need to know which one suits the needs of your company first so that you can start there?
Right. And that's a great question. And we get that all the time. And to be completely honest with you, an implementation is not the easiest thing in the world. So that's why we talk so much about understanding what the goals of your company are. Now, if you have QuickBooks now and in 4 years you want to transition to, a Uninet, that's something that can happen and can take place. But, the one thing you want to avoid is you're on QuickBooks now, then you want to jump up to Jameson a year, then next year you want to jump up to Uninet. It's costly. It takes a lot of time to do. And it doesn't give you the best financial data possible, because a lot of times in implementations, there's certain things that you want to be aware of, specifically with the contract module, specifically with the contract history, the general ledger, that bringing over that information to a new system can really be harmful to the tracking of some of the contracts. And we see it all the time. And basically what happens in that perspective is that there's a lot of extra cost to administer contracts until those ones that were open when the system was converted are gone away. So with that being said, do you need to immediately jump on a larger platform? The answer to that is no. It can be changed over time. But what I would say is just to look into each of these options, understand, some of these do a transaction by transaction cost. So you're not paying for the whole kit and caboodle up front. You're basically saying, the smaller my company is, the less I pay, and then it grows over time. So I know Uninet has an option for that. But then, QuickBooks also is a relatively cheap option that you can eventually build up over time to maybe a Deltek. So that's a great question. There's a lot to be thought about in there. And if you're, looking at your information, what contracts you want to go after, and have any more specific questions, we're happy to field those questions and maybe suggest an option that may be best for you if you'd like to set up a call sometime.
Yes, thank you.
Is that a helpful?
Excellent.
Yep, sure thing.
Excellent. Go ahead. You answered the question I was going to ask as well. So,
Sure.
Danny, please continue.
Now that we have some information about the accounting system and structures as it relates to government contracting, we'll get into some of the types of contracts. Justin, if you could update to that. So we're only going to touch on a few. So FAR Part 19 that Justin already mentioned, Federal Acquisition Regulation, talks specifically about some of the contract types that are out there. I believe there are like 16 in total. But basically, what that does is it kind of lays the framework for what types of contracts you could win with the federal or state and local governments. The federal and state and local governments do business slightly differently, but we focus on federal because if you're doing federal right, then you can administer any contract in the state world. And a lot of the states are trending in the direction to mimic more of the federal government. So that's just something to keep in mind as you go through. So firm fixed price is relatively simple. That's similar to a construction industry where you and the federal government have agreed upon a price. Doesn't matter what your costs are, you're getting reimbursed that contract price. It may be monthly installments. It may be over time. It may be different each month, but at the end of the day, you're going to bill the federal government or state government that agreed upon price. And it is subject to change orders, additional task orders, et cetera. But that's a pretty basic contract that is often awarded with the government. So then you have fixed price, level of effort, and time materials. These two are essentially the same. Basically, there's an agreed upon bill rate based on the contract agreement, and you're effectively billing certain individuals at certain rates for the hours that they've worked. The only difference between the two is that a fixed price level of effort usually has a ceiling. So if you go over that, you run the risk of a ceiling number of hours. So if you go over that, you run the risk of bearing the costs on your own. Whereas a T&M, typically you're getting reimbursed until the service is done. So the next place that we'll go into is the cost reimbursable type contracts. And this is really where the industry distinguishes itself from everybody else. These cost reimbursable type contracts are pretty complex. The most common one that's
cut out. Okay, looks like he may have. Yeah, he may have cut out. But what he was referring to with the most typical one is the cost plus fixed fee contract. So what that is you're able to reimburse the government for your cost plus a negotiated fixed fee. In which most cases it range kind of from 4% to kind of the 8 to 10% range. The good thing about these contracts is you have the ability to apply your indirect rates on top of that. So what I mentioned previously, talking about the indirect rates. So not only are you able to get a reimbursement from the government for the time and the materials that you spend on a contract, you're also able to get reimbursed for, let's say, your fringe benefits or kind of your overheads. You get reimbursed for a piece of that, and we'll go in that when we go through the calculation of an indirect rate. But so what you do is you apply an indirect rate on top of of the labor. You apply an indirect rate on top of the materials, and then the government will reimburse you for those costs as well. So that's kind of what we wanted to touch on a little bit for the cost plus fixed fee contracts. Then you have the cost plus award fee and the cost plus incentive fees. Those are kind of rare, but we did want to let you know that those are out there. But you would rarely see those kind of starting out, and then once you get to a certain level, then you'll start to see that more and more. So I'll jump into kind of how to get started. And basically what we want to just share with you a little bit on how to plan for success. I think the first step really to what you want to see is you want to see what is the long-term goal of the company. You want to set yourself up for success. You want to take a look at your vision, take a look at what direction you want to go, because if you look out in front, it helps you in terms of planning and planning for the future. So you want to know what types of contracts your company want to go after. And that can be types of services that you provide. You want to make sure that the services are in kind of in your wheelhouse in terms of the services that you perform. In addition to the types of contracts that are out there, whether it be a fixed price contract or a T&M contract, each contract is going to vary in terms of what's going to be beneficial for you as a company. Whereas if for example, let's say if as a company, you have the ability to keep your costs down, well, it may make more sense for you to have a fixed price contract. You may want to think about, yes, I can negotiate with the government. They're going to pay me this amount, regardless if I have, $1 spent on expenses or, hundreds of thousands of dollars on expenses. So if you want to look at that in the beginning, see what types of contracts that you want to go after. You want to understand the impacts of the long-term and short-term decision-making. Danny briefly touched on the accounting system. Angel, I know you mentioned about the accounting systems, and can you start with one now, and then is it costly to move forward? Just having that upfront. If do I see myself growing, and how fast do I see myself growing? Right. So you don't want to jump out there and get the most expensive accounting system on the market when you have kind of a 5-year plan. You have a step process that you want to get to, because it doesn't make sense, because you may not need all of that information, or you may not need all of the services in the beginning. So you can start with a smaller product like a QuickBooks, and then kind of build your way up as you kind of grow and see yourself growing over the years or over time. You want to also think about the accounting expertise. One of the things that we see a lot in this industry is folks, they don't really necessarily want to spend money on the accounting until they really have to. And a lot of times what that does is that burns you in the back end, because it's very costly to come in on the back end to fix things, as opposed to just seeing, looking at it from the beginning and putting, whether that be hiring an internal team to kind of run your accounting function, or hiring kind of an external, outfit to where they could provide the accounting services for you. You want to see what's going to fit for your company, and see what makes the most sense. And if it makes the most sense to kind of go either direction, you want to be on the lookout for that. You want to see who to work with. You want to that goes with which government agencies you want to work with. Whether if you want to work with different levels of state and local government, federal government, whatever the case may be. You want to be able to you want to have an outlook on that, because what could happen is you can develop a good relationship with some of with one organization who could then refer you out to different organizations. So you want to have that ability to pick the right folks to work with in the beginning. And again, it all comes from planning and decision making right from the jump. So I just want to kind of go on some of the things in terms of understanding requirements on a contract. Again, some of these contracts are tough in terms of understanding what exactly is stated in the contract, the type of services they want you to perform, the type of legal jargon that they may have in it. We recommend you kind of getting legal counsel if there's something in a contract that you don't necessarily understand. Run it by the legal team just to see if it makes sense for you and your company. We also recommend if you have an accounting firm that you're working with, running certain details of a contract or certain terms of a contract by that accounting firm to see if they could provide some insight on that, or if there's anything that something that they may have seen in the past, or where they could provide you with a better level of detail. Also, you want to make sure that you're staying in compliance with these contracts. All of these contracts have different compliance requirements to them, and you want to make sure that you are one. You want to know what those requirements are, and then you want to make sure that not only you're staying in compliance with it. If you have any subcontractors or any 1099 consultants that are working on these contracts, you want to make sure that they're staying in compliance with it as well, because then you're going to be held by those. The company as itself is going to be held by those same standards. I did want to touch on a couple horror stories. I know Danny did have one. He didn't jump back in, but I'll touch on a horror story myself, just to kind of oh, looks like Danny's come back.
Yeah, I'm still trying to work out my video. Can you hear me okay?
I can hear you. But yeah, we're on the first steps, and we're talking about horror stories. So I know you had a horror story you wanted to share.
Yep.
With the group, just to for something that they should be on the lookout for, because at the end of the day, you want to set yourself up for success in the beginning, because setting yourself up for success in the beginning can save you a lot of time and a lot of money on the back end. So I'll turn it over to Danny for that there.
Yep. So absolutely. One of the things that we want to make sure that the CEO and CFO get to focus on, like I've always said, is the future. So what we don't want to have happen is having the CEO, CFO call us because there's a problem they have to go back and fix. So a lot of times when the company isn't set up with the right accounting team, with the right accounting system, and with a good understanding of what contracts they're bidding on, what RFPs they're bidding on, which I sell on that question on the side, the contract type will typically be specified in the request for proposal from the government. But basically, the biggest thing is that we get into these contracts, we'll find out that a company can't administer a certain type of contract, and within a week, they need to turn around to be able to have a system that's compliant. Within a week, they need to all of a sudden submit something they didn't know they had to, and they'll submit it, and inevitably it'll have errors. So they'll come to us after they've already submitted it late, and have to go back through everything and fix things in their accounting system. So what happens when that's the case is the CFO and CEO usually have to come in and work with us to get to the point where they understand what's going on in the past. So oftentimes incurred cost submissions is a great example, which we'll get to in a second when we talk about indirect rates. That's a required part of cost plus contracts. But what happens is those go under audit or subject to audit once you are through each year and once you're at the contract closeout phase. And if you don't have all your ducks in a row, that has the ability to drag on for years. We've seen clients that are 6 years after the finished year and they can't close out any of their contracts because they didn't have good accounting for them from the start. So that's just one of the biggest things that we want to make sure that you're investing in a good team, the right people with the right experience, so that you can avoid problems down the road and really just focus on the
All right. So now we'll touch a little bit on the indirect rates and kind of cost of liability.
Yep. So my camera isn't really working, so I'm just going to keep going if that's okay with just the sound. But basically, with indirect rates and cost of liability, we've been touching on it throughout. This is a hot button topic in the government contracting industry and something that is specific to the government contracting industry. So I'll briefly go through what these are and then how they're accounted for. So a direct cost is any cost that's incurred directly related to the performance on one specific contract. So basically, anything that's called out in the contract that you'll need to do, any required training that's specific to that contract, whether it's something that you can bill or not, is a direct cost. Then there are indirect costs. Basically, any cost that's incurred as a result of having the contract.
Oh, looks like Danny may have cut out again. But I can pick up. So as he mentioned, so indirect cost is any cost that's incurred for having the contract, right? So that's your G&A, that's your overhead, that's your fringe. So those are the costs. The fringe, that's for having the people. Your G&A, that's for having the back office, that's for having the accounting staff, having the kind of the CEO salary. So those are going to be costs for having that regardless. And then you have your overhead. Oh, so I mean general and administrative. So so that's
Justin,
typically
what do you mean by
your
G&A?
accounting, your marketing, your advertising,
Gotcha,
all of those things kind of fall under the G&A threshold.
Exactly, support the contract. So,
and he cut off. Yep. Yeah, he cut off. That's fine. Yep. We'll keep going. So you have your
sorry, Danny,
you have your G&A,
you
and then you
hear
have your
me,
overhead.
he
And the way you want to and the way you
Okay,
can
let's
differentiate
let's keep going,
G&A and overhead is the cost for administering contracts. So that's a facility, right? So if you need a facility to kind of administer this contract, if you need for all your rent expense for having this one contract, if it's overhead is something that's only there because of contracts, whereas G&A is going to be a cost that you're going to have regardless. You're going to have CEO salaries. You're going to have kind of a CFO salary regardless. You're going to have a portion of the rent for the headquarters that you're doing your business out of. You're going to have those costs regardless. So that's the way to kind of differentiate your G&A versus your overhead costs. And then your fringe are all, that's all your benefits with your salaries, the PTO, vacation, health insurance, and all of that. And so we have a note down here. It's just basically a cost doesn't need to be billable to be direct. So for example, like if it's training for a specific contract, although that training isn't directly for that isn't going to be billable to that contract, it is related to that contract. So you may not be able to bill it to the government, but it is still considered a direct cost. So we did want to make a note about that for you all. I touched on this here. So your types of indirect costs. Just your fringe, overhead, and G&A. Okay. So again, if you all have any specific questions on the different type of cost segregations, we can feel free to let us know. We can send you this information or clarify any specific questions you do have. Okay. So I wanted to briefly get in a little bit to how to calculate the indirect rate. So when we talked about all those indirect costs and how you can apply those indirect costs and for reimbursement from the government. And so what you do is you have cost pools and you have cost and you have a base. And the way to calculate the rate is you take the cost pool and you divide it by the base. So what a cost pool is all costs that make up a certain pool. So for example, fringe is an easy one. So all costs that make up fringe. So all of the vacation, all of the health insurance, all of the 401k that you're paying to your employees, that's going to be considered the fringe pool. And then the base is what's going to be applied to. So that's all your labor. So think about it. If you have direct labor, you would take all of the costs for in the pool, divide that by the base, and then that's going to be the rate that you can apply. So every time you charge someone out as let's say for direct cost, you can also apply that fringe rate for that actual employee. So it's a good way to say, yeah, not only are we recouping the cost that we have to spend for this employee, we're also recouping a portion of the fringe benefits that we have to pay to that employee. And then the same thing with the overhead and your G&A, because there is a portion of cost that's associated to each one of those. So it does these cost plus contracts give you that ability to apply those indirect rates to the cost that you're incurring. Yep.
Mm-hmm.
Okay.
So Justin, we probably got like another minute or two and then need to jump.
Yeah, no, sure, certainly. We actually
and
have
I
just
don't know whether
one more
there's any
slide
more
left. It's
lingering
just
questions
the
out
indirect
there.
rate cost,
So
indirect rates and cost allowability.
just keep that in mind.
Basically, we wanted to touch on this because and what Danny was mentioning and segregating the unallowable cost. The reason why you want to do that is because these costs are not going to be reimbursed by the government. So you want to make sure that you have these costs segregated. So if you have anything for advertising, alcohol, you want to separate these. You want to break these out because when you're calculating these indirect rates, you're not able to apply those when you're doing it. So that's kind of the last thing we wanted to touch on. But we did want to leave enough time, if you all did have any questions that were pertinent right now. Again, you can feel free to reach out to either one of us directly if you have any specific questions. But I'll be more than happy to field any questions now.
Great. Folks, any last questions that we can ask Justin? Or if not, let's just say thank you and
Yes.
We'll kind of get moving and
yes,
move
we
on
do
to the
have
next
that.
thing. Justin,
here's our contact information
deck,
here.
the
But
contact
I can also
information for
send
you and Danny.
John the slides, and so if anyone would like to get in contact with us, or if you wanted to share the slides, you can feel free to do so.
Yep. Thank you so much. Really appreciate your time, you and your partner. If you would share, there it is. Would you share our regards with Danny as well? And obviously I can tell just from the expressions on folks' faces, this was definitely a deeper dive than we did yesterday. And I suspect there are quite a few questions that need to be answered, and that we'll take them offline. And you have the contact information, folks. So let's go ahead and take advantage of the opportunity that Justin's making available. Thank you, Justin, for your time. And we look forward to talk to you again. Thank you. Take care. So folks, Celine just dropped in the chat log the link. If you just